Welcome to Investing by the Books, a podcast by Redeye. I'm your host Niklas Sävås, and next to me is my friend Eddie Palmgren. How are you today, Eddie?
I'm great. It's really a fairy tale day here in Stockholm. Minus 15 degrees, snow everywhere, and the sun is about to set, although it's just 2 p.m. But I'm really excited because today we will talk with Chris Mayer, co-founder and portfolio manager at Woodlock House Family Capital, and the author of multiple books. The one he's most famous for is probably the one we will discuss today, 100 Baggers, which is a study of the best performing US stocks that each, for every $10,000 invested, have returned $1 million and often more. And the publisher spent $50,000 just to get the data, which spans from 1962 to 2014, and it resulted in 365 stocks that returned 100-fold or more. And the largest inspiration for Chris to write the book was Thomas Phelps' book 100 to 1 in the stock market from 1972. So why have we chosen the book from Chris Mayer?
Well, isn't it everybody's dream to find a stock that returns 100 times your money?
Sounds too good to be true almost.
Yeah, it does. 100 Baggers is an important book for many reasons, but maybe most importantly to raise awareness of the astonishing return investors can gain from buying great companies and holding on for the long term. Patience is an attribute that seems to be more important for every year that goes by, which is highly emphasized in this book. There is a quote in the book which I like a lot, and which also points to the benefit of a buy and hold approach. And it goes, forget about the trading and use the time you would have spent monitoring the trade with your family.
Good advice indeed, and the book is full of success stories from both business and investing. And for those who have read William Thorndike's The Outsiders, it shares many similarities with that one. And also our first guest of the podcast, Sean Iddings, the two books on intelligence fanatics that he wrote together with Ian Castle are similar. So how does the 100 Baggers fit with the Redeye quality rating, Niklas?
So 100 Baggers is focused on finding companies with quality attributes. And I would say that is exactly what the Redeye rating is about. We rate the companies in terms of the quality of the people, the business, and the financials. And I would argue that the method shares many similarities with the one outlined by Chris.
The book 100 Baggers, Stocks That Return 100 to 1 and How to Find Them was published in 2015. And to help us increase our understanding of these magical stocks, we are truly grateful to have the author on the show today. Here comes our conversation with Chris Mayer. Hello, Chris, and welcome to Investing by the Books podcast.
Thank you for having me on. Good to be here.
Where are you today?
I am in Gaithersburg, Maryland, near Washington, D.C., in my home office.
Nice. I see a lot of great books behind you.
Yeah, it's my library here. It's got my investment books over here, philosophy books, a bunch of things.
Cool. And one of the books that we wanted to talk about today is the book you wrote on 100 Baggers. And we think it's a fascinating topic because it can really create life-changing wealth to achieve one of those 100-fold returns. So can you start out with telling us your favorite, or one of them, 100 Bagger stories?
Well, I like a lot of them. I don't know that I have a favorite, but I guess one that comes to mind because it did it so quickly and because it was in the numbers and that you could have seen it developing was Monster Beverage. And that's a case study that I cover in the book. And so Monster Beverage became a 100 bagger within 10 years. And in that 10 years, it kind of packed all the lessons. It had a number of severe drawdowns. I think there were a couple of months where it fell, 20 or 30%, maybe even 40% in a single month. So you think about one of the lessons that comes out of the 100 bagger study is the volatility involved, and also long stretches where stocks don't go anywhere. For Monster, you had some severe pullbacks along the way. But one reason I really like it is, and I talk about this in the book, is that you could just see it in the numbers. You had a few years where you could have bought it at any price it was trading at in those 3 or 4 years and still made 100 times your money. And you could have seen rising sales, growing sales at a very high clip, high gross margin, high profitability, high returns on capital. And so it was all there in front of you. Is all you had to, you do is buy and hold on to it. But it was also a little controversial. As I mentioned in the case study, there was a very compelling and smart sounding short report written about it early on, which could have scared you out. So yeah, that's one of my favorites for those reasons. Yeah.
Thanks, Chris. You mentioned also that there are two typical ways for a stock to become a 100-bagger, where one way is far riskier than the other. Can you explain that?
Well, you may be referring in the book, I talk about how there are a number of stocks that I sort of weeded out of the study. So these were ones that are like junior minor stocks that are trading for, 12 cents, and then they hit some sort of deposit and go up 100-fold, or some biotech, tiny biotech that makes a discovery and goes up 100-fold. So I weeded those out of the study because what I was looking for was stocks that we could somehow predict or that you could see. Like, those are really unpredictable, wild outcomes that you would never be able to figure out ahead of time. But if you found, a McDonald's in the early goings, or a Starbucks, some of these things, they were pretty good business. They were good businesses right from the start, and they had a lot of the handles or clues that I talk about in the book. So you have a shot for, maybe discovering it. So that's why, I divided it up into two, and I was much more interested in the ones that had financial attributes that an analyst might be able to look at and think about and project into the future.
And you also discuss about the twin engines needed to create a 100-bagger.
Yeah, the twin engines are very helpful. They can do, so the twin engines, one is you just have a lot of growth. So if you have, a company that's compounding sales at 20% a year, that's a nice a tailwind, obviously. But combined, if you have a stock that's trading at, say, 15 times earnings when you get involved, and 10 years later, after 10 years of 20% growth, it also now is trading at 45 times earnings. Obviously, that can do a lot of work for you and get you to that 100-bagger status quicker. And so many of those 100-baggers had some sort of tailwind like that. And they were amazing companies. I mean, there have been times when you were able to get them at very low multiples of earnings and cash flow because of cyclical bear markets or something like that. So that makes your work easier if you can find those. You don't need necessarily to have both twin engines. You have stocks, plenty of examples of stocks that seemed expensive the whole time. They just grew and grew and grew and got there. But the twin engines is kind of a neat little concept to keep in mind, that you can get there partly with multiple expansion helping you along the way. A task that is much more difficult in today's market.
Yeah, and another person who has looked at some of the most successful businesses is Sean Iddings, our first guest on the podcast. And he talks about the importance of building your pattern recognition to be able to identify these special companies. So we're curious, how much has writing the book helped you to become a better investor?
Well, I like to think it's made me a much better investor, and it's interesting because it didn't happen right away. So I did the study and wrote the book, and it certainly had an impact on how I think about things. So I began to appreciate much more the importance of reinvestment. That's what I always tell people, is that it's not just finding something that's highly profitable or has great margins, great returns, but also that has the ability to then take those cash flows, reinvest it, get that return again, and continue to do it again and again and again. That's where you really get powerful compounding effects. And the study really made me appreciate that and make that more important part of what I do. But I still sort of clung to what you might call a more valuation-centric approach for years afterwards. So even me, writing the book and doing that study, it took a while for it to really sink in and change me for good. And over the years, as I started to put more and more of the things I write about in the book in practice, I started to see that really was the way I wanted to go. And I started to become just much more focused on that. I would say before, I was more of an investor who like a lot of investors, they have different buckets and different arrows in their quiver. They do some special situations. They might have a deep value over here. They've got their growth names, but as time has elapsed, I'm just much more focused now on just these. And that's how I built Woodlock House now, is to focus on just finding 10 of these kinds of names that I can sit with and run.
That's great, and I think many investors refer to you as the 100-bagger expert now. But can you describe a bit more on your evolution as an investor? I mean, having done some reading about you, I read that you have you studied the monetary history, for example, before. But that's something. I mean, when I read this book, you focus more on the company fundamentals, of course. So can you describe that a bit?
Yeah, that's a good question, good point, because every investor sort of goes through an evolution, and I don't know why, for me in particular, maybe because I was so inherently curious, I ran the gamut, did everything. I mean, when I started out, the first time I got interested in investing was when I started to learn and read more about Warren Buffett, and then that led me naturally to his teacher, Benjamin Graham. And so I kind of came into the world from that approach. But then I read lots of other things. I read Peter Lynch's books. They were a big influence. And early on, I read everything: macro books, trading books, books on technical analysis and charting, and just kind of exploring and experimenting with that whole world. So it took some time. I would say then I sort of settled in with kind of more deep value approach for a while. I know Marty Whitman was another investor who was an important influence early on. And and in the beginning, I did also pay a lot more attention to macro, talking about monetary policy, and the economy, and very different than the way I would do it now. But then over time, I graduated more and more towards focusing more on just companies, and that's where I am today. So everyone has their different paths and where they settle in, and part of it's temperament and your own experiences. But for me, the appeal of this 100-bagger style approach, I like the simplicity of it, and it takes a lot of the extraneous noise that distracts investors out of the process.
That's really, really interesting. And if we then go in a bit more on the 100-bagger aspects and the characteristics of the 100-baggers you have studied, I wanted to mention just at Redeye, where I work as an equity analyst, we have a rating model where we rate companies based on 3 pillars. So people, business, and financials. And we have a set of questions in each category. And I want to start with people. And you seem to like owner-operators. And I'm curious to know your explanations for why owner-operators create more value than managers without skin in the game, so to speak.
Yeah. So as I've gone along, one of the things I've learned is that investing is a people business, just like business in general is a people business, and they're very, very important. And I think, I had a background in banking, and when you're a credit analyst, and then you're a loan officer at a bank lending to middle market companies in the area, I was taught that the character of the people is the most important thing. And so I always thought that was an interesting lesson. But, older and wiser bankers would tell me that even if you love the business and you have great collateral, if you don't trust the people, don't do the deal, because they'll always find a way to kind of screw you in the end. And so we spent a lot of time kind of, getting to know the people. And so that kind of carried over to investing. And then I remember I read Marty Sosnoff's books. There are 2 books in particular. One is called Humble on Wall Street, and another one is called Silent Investor, Silent Loser. And he was big on this idea of investing with people who have skin in the game for that same reason. Hey, you have somebody who's they're an investor alongside you, their interests are aligned, and so hopefully, in theory, they will make better decisions than someone who is not aligned in that way. So I really liked that idea. I liked the way he talked about it. And then I started to read and do more research on it. And it turns out there's a pretty decent body of academic research that covers this as well. So there's studies that will show if the CEO owns 10% of the stock, how he outperforms his peers over a certain amount of time, he or she. If there's a family involved, there's lots of research shows how family-owned companies outperform their peers over time. So I started to collect these kinds of studies, and so that's how that developed. And of course, there's always exceptions, right? There's always owner-operators who take advantage of their minority shareholders, and those are ones you certainly want to try to avoid. And then culturally, I'm not sure it necessarily always translates, because I always get the question, somebody will say, well, if you go look throughout Asia, China, there's lots of companies where insiders own a whole lot of the shares. It doesn't necessarily mean that they're outperforming, because in some ways they think about it differently. And
it's more their own piggy bank, right?
More their own piggy bank, exactly. So you have to be careful. I put that caveat in there as well, that it may not translate across cultures. But it works pretty well in the U.S. And it's also, an underappreciated aspect of it is psychological aspect, which is when you're invested with someone like that, when times get tough, when the market tests you, as it inevitably will, you sleep better at night knowing that you've got guys and gals at the helm who are going to make those decisions that you already trust and know and who are invested alongside you. So that's a big part of it as well.
And do you have a quantitative measure for what you define as an owner-operator?
People love to ask me that question, like, is there a magic number? Is it 10% or 5%, 15%, whatever? I would say not really, because sometimes you might have a CEO owns 5% of the stock, but that might be all of that person's net worth. And in which case, pretty significant. You might have a CEO that owns 15%, but it's the smallest holding that CEO has. And so maybe it's not so important.
Yeah.
So context is important.
Yeah, we have the same in our rating model. We have 5% threshold, I think, or if they have most of their own money in the stock.
Yeah, especially because someone's younger and they started the company and kind of went up. There was no way for them to accumulate a great deal of wealth. So that context is important. And incentives. So sometimes, incentive schemes are generally pretty boring. Most companies have similar comp schemes, but every once in a while you come across something that's interesting. It maybe has a unusual incentive system tied around some return measure that, is appealing to you as an investor or really ties them in some way. So, incentives are important too.
Do you have an example of such incentive that raises your curiosity?
Well, we talked about a little bit before the podcast a number of Swedish companies, these serial acquirers, and one of the things that fascinates me about those companies is their focus on return on capital employed, and that permeates their organizations. So their incentives and the managers are focused around that, a return metric. That's interesting. That's what you would want. It's not a usual sale getting necessarily just compensated on increasing sales and profits, but they're thinking about return on capital. Sort of really, that's the magic of creating value as an investor.
Yeah, and that ties into capital allocation, which is a very important decision and something we have discussed with several of our guests here in the podcast. So what are your thoughts on how to evaluate those decisions?
Yeah, capital allocation is critical. And there's that Warren Buffett quote where he says the CEO over 10 years, deciding where 10% of the profits goes, eventually winds up deciding where 60% of the capital goes, or something like that. So over time, capital allocation decisions become huge. So how do you evaluate it? Well, number one, you've got track record. So you think about it, when you think about it, there's only so many things you can really do. You can either buy other companies when it's cash. You either pay it out to shareholders in some way, you buy back stock, you pay back debt, or you just let it sit in cash. Those are kind of your menu. So how do they do it? I mean, does the management team pay out a bunch in dividends? And do they do it regardless? This is very prevalent, but it's a little unfortunate that companies have these dividend policies that they just stick to regardless, versus making a decision. Do they have better ways to invest it or not? It's this kind of automatic payout, and that's but sometimes you can't be too critical of a company for that if it's so widespread. But ideally, you'd like to have a company that's more thoughtful about which of those 5 areas of capital deployment they go after, they think about. So, yeah, how do you evaluate track records? Number one, if you see, paying for high-priced acquisitions, if you see, buybacks that seem to be done at irrational times when the stock's when business is well, they're buying back, and then suddenly when things go badly, they stop. The footprint on acquisitions is another important one to see the track record of that. So capital allocation is really important.
Yeah, and also to know who is making the decision.
Who's making the decisions, yes. Who's involved in what.
We have discussed incentives and capital allocation. What do you look for in terms of culture in a business?
Yeah, culture is another thing that's really important that I've come to appreciate more as I get older. And I think the culture I look for is, at least become part of my regular due diligence on a company. My regular questions is to try to see what turnover looks like, certain levels, on the theory that a company that has lots of employees that stay for a long time is probably a good place to work. Do they promote from within? I like to see management teams and where the people have been with the business a long time. They've been promoted within. They're now running substantial divisions within the company. So a culture of that kind of culture is good. A culture of employee ownership is nice. Brown & Brown is an insurance broker I have, where the employees own almost as much stock as the Brown family. And so that's kind of a nice thing. Domino's Pizza is kind of an interesting case study in this too, because if you look at a lot of their franchisees, they were almost all drivers and people who worked for the business for a long time. So there's an interesting culture there. They just don't take you, if you just come in off the street wanting to own a Domino's franchise, you got a hard road to go. They don't typically do that. So those are little cultural markers, think about, which is really focusing on employees, turnover, kind of how they treat people. And those are the cultural markers to look for. It's a tough question because it involves also talking to people who used to work there. Competitors can sometimes give you a good sense.
Do you also look at like employee surveys and maybe Glassdoor? Or
I know some people, investors of mine, friends of mine, who use that. I don't typically do that. It's not part of my general process, but perhaps I should. I mean, I've heard people tell me that it can be good at the extremes. So a lot of times comments on there, people complaining or whatever. But if you're overwhelmingly on one side or the other, it might give you an insight.
So you're trying to talk with people in the company who has worked there or worked there?
Yes, I try to. And in fact, a lot of times I'll have to say that some of my better conversations have been with people who used to work there or work there now versus people in the executive suite, because, the CFO and CEO, they talk to investors. They know what we want here. But like I'm invested in Copart, and if I go and talk to somebody who runs a Copart yard, you get a different perspective. You get to see how things really work on a day-to-day basis.
Yeah.
What are the real daily pressures of the business? What works well, what doesn't? It can be really insightful.
My next question was how do you get hold of these people? But of course, it's easier in the businesses where they have a physical store or so you can visit. But otherwise, it can be tricky to get hold of them.
Yeah, it can be tricky to find employees. You're right. If like on a Copart, they have physical locations, it's a little easier. But yeah, I mean, there are other ways. There are expert networks that will help you track down people.
LinkedIn is pretty good, I think.
Yeah, LinkedIn. There are ways.
If we take a more practical example, then maybe you've found a company that you're interested, that has piqued your interest, and you get the chance to talk to the management team, but you only have the chance to ask one single question. What would that be?
Oh, that's a good one. Well, I think I would focus somehow on competition. And because I'm thinking about all the questions that I typically ask management teams, and of course it varies by business, and depending on the type of business, there's different things that I might try to learn from them that I can't necessarily get so easily just by reading filings and whatnot. But I always like to ask a question about competition. So, what separates them from their competition, something along those lines. And if you get kind of a pat answer, that's kind of a negative. Hopefully you'll get a thoughtful answer about what exactly drives that business. And sometimes, they have a definite good understanding of what makes them different. That would be a big plus.
And a red flag would be if they say that they have no competition, I guess.
A red flag would be if they say something like what you would expect to hear. Oh, we have great people and great service, and just kind of buzzwordy things rather than something tangible by saying, well, like a Copart could say, well, we've got yards that we've built up over a couple decades, and we've got them in locations that are close to our customers, and it's very hard for our competitors to replicate that, or if it's, so something like that, a more thoughtful answer.
So before we move into the business side of things a bit more, I mean, of course, we did that when you mentioned the competitive side, and I just want to let you give us an example of a company that checks all the boxes from a people standpoint.
Any of my companies I have now would be a good example. So it's just a matter of which one I feel like talking about. I mean, I mentioned Brown and Brown. I think that's a good example. The CEO is actually, he's a third generation, which is unusual to have the family's skills go down that far, but he's an excellent CEO. I mentioned, I talk to the CFO every once in a while. I think he's a thoughtful guy as well. When you ask him questions about the business, you don't get the usual, you don't get pat, buzzwordy answers. I think they focused on the things that are important. They think like business people. You talk to them, they'll talk about free cash flow. They talk about the things we want to hear them talk about. And I mentioned them earlier as far as people goes also because they have that culture of employees, and employees are a significant shareholder in the business. And they encourage that as well. They have a stock plan where they allow employees to buy stock at like a 10% discount or something like that. And that's been a very good thing for them to do over the long term. It's one of those companies too you go to, and some people have gotten very wealthy over time working there, and that's good. And they're owners, they should be. So, that's one example. I mentioned Copart. That's another good example because it was a founder-led company. Willis Johnson founded it. Jay Adair is the CEO. And he's another good example because he came up from the business when he worked there as a teenager, and now he's running the show. So, I think, there's a lot of good examples like that.
Seems like you have material for a follow-up on the 100 baggers already.
Yeah, I definitely. I mean, if I were to write it, I would think I would write it differently. I'd certainly have some different examples, and there would be some things I'd emphasize more than I did in the book. And the ones we're talking about already would be the ones I'd emphasize more: the people, culture. You never stop learning, so you always pick up new things.
Exactly. So moving on to the business side, which business models do you believe will be the most successful in the next 50 years?
Next 50?
Yeah. To put it easy.
Well, I think a lot of the same models that are successful now will be successful then. So big picture models like franchise businesses, royalties, those kinds of structures won't go away. network effects, especially built around software, those won't go away. So that's big picture sense.
And one part of the 100 bagger story is, of course, growth. And you mention it in the book, and you need it in all dimensions. It's sales, it's margin, and valuation. So when you analyze companies, how do you weigh these different factors in terms of growth?
Yeah, that's a good question. Well, let's see. I think I like to have at least kind of double-digit sales growth. I think a lot of it flows from that. It's hard to find any kind of 100 bagger where you weren't growing at least something like that. Now there's operating leverage, and so yes, so cash flow can grow faster. But you still need to start with that top line growth. And plus, that's also an indication of other good things that are going on with the business. Business that's growing like that, 20% a year is probably a business has something special and that's doing something that warrants some investigation. And if they can do it for a long period of time, that does a lot of work for you. So I think I would start with that, and then secondarily look at the margins and cash flow and how that tracks it. Ideally, you'd have it growing a little faster. You get a little leverage in there, a little operating leverage or higher margin growth. And then you mentioned valuation in there. I mean, valuation is important as well, of course. One thing that I've been telling people and writing about more recently, I think I put this out on one of my more recent blogs, is that it's important to get the business right. More important to get the business right than the valuation right. And it took me a long time to learn that lesson, where before it'd been very valuation focused, because that seems more certain, easy. You buy something, book value, you buy something, whatever. But if you get the business right, and you really have a business that invests, that earns a high return on capital, has the ability to reinvest that at a high rate, and can do it again and again and again, then that's going to bail you out if you overpay a bit. Versus if you're very precise and you got the valuation right, but the business, you got that wrong, and so the valuation is not really going to help you over the long run. Maybe if you get out quick, you don't lose as much as you thought or whatever. But yeah, I think business first, valuation second is what I like to say.
So do you look at, for growth, do you look at some structural growth themes, or are you like 100% bottom up when you check for companies?
Combination. I prefer to have the whole industry kind of growing. It's nice to have a business that's growing a lot faster than its peers, but if the overall industry is shrinking or not growing much, then it's going to hit a ceiling pretty quick. So ideally, you want to have as open-ended growth possibilities as possible.
And there's a lot about talks about moats, and we had discussions here in the podcast as well with Heather Brilliant, for example, who wrote a Moats book. But do you think it's becoming like overrated, that everyone is looking at moats?
No, I don't think it's overrated. I think it depends on your investment approach. If you want to be a long-term investor, you want to hold on to a business for a long time, then it's absolutely critical that you own something that has some sort of competitive advantage. You want to call it a moat, call it whatever you want to call it. But basically what you're looking for is, if you're investing in a business earning high return on capital, then that is like a honeypot. Why wouldn't other people try to do the same thing? You're going to have competitors try to replicate it, and the natural sort of flow of capitalistic markets is that those high margins and high returns get eroded away over time. So you have to figure out a reason why that's not going to happen in this case, and that gets to moats. I mentioned Copart before. They have a moat that is more of a physical moat, so it's a good example to use because it's easier to understand. They have these huge yards where they have all thousands of cars, and if they've been around a long time, it's very, very difficult to find that kind of land. So they've got 100 of these things all over the country, and you can see how that's a competitive edge. So it's very, very difficult to compete with them to require an enormous amount of capital. And even if you had it, you wouldn't necessarily be able to get all the yards they do. And that's why that industry has kind of evolved into an oligopoly between Copart and insurance auto auctions. So that's a good example. But when you look at the financials of the last 5 years, 10 years, 15 years, you can see that high return on capital persist and even kind of grow as scale comes in. And you can feel pretty confident that it's almost impossible for a competitor to come in and arbitrage that away or take that away in some way. So I think it's critical. There are lots of different ways to have moats. I think sometimes I don't think investors make the mistake, that it's too popular, people looking for moats, but I think people might focus too narrowly on what makes a moat. And I've written about this as well. One of my blog posts is called Invisible Moats. And that's a moat where you have it's built really around the culture. And the example I used in that was ODFL, Old Dominion Freight. It's a great company. It's a trucking company. So you would think, there's no way to build a competitive advantage in that business. But if you study that business, you find that they've generated high returns on capital for a long time, exceeding the industry, exceeding their peers. And they continue to outperform. And they have a great culture there. It's a family-owned business. Family owns a decent percent of the stock. The employees are, aligned. There's a lot of employee ownership at that company. So they've got something special that they've been able to replicate. And so even in an industry that otherwise seems hard to defend a high return on capital, they've done it. So I think, you look at the financials. So, sometimes companies claim they have a competitive advantage, but then you look at the financials and you're like, well, where is it? It's not translating necessarily into better margins or better returns on capital. So I think it starts with that. If you have a company that has higher returns on capital, then you reverse engineer, well, why are they able to sustain it? And if you do that, you'll find interesting ways that companies can create advantages.
So we talked about growth, we talked about moats, and in your study of 100 baggers, is there any other business characteristics like size, industry, markets, or so on that you have found as a common pattern?
Well, yeah, size. I mean, to the obvious degree, you want to stay on the smaller spectrum. I mean, you're not going to buy Apple today and expect to go up 100-fold. So in the book, I put the limit pretty low. I think that might be something I change a little. I think I had 300 million was the kind of where you want to stay. And I think you can get quite a bit bigger than that. So the size obviously is a factor. Industry is an interesting one because one of the things that came out of the study is it doesn't seem to be that important. So when I started it, I suspected that tech would be a big, dominant piece of the study, but it really isn't. I mean, if you look at the 100 baggers that are in the study, and it's in the index of the book, they come from all over. There's energy companies, consumer product companies. So I don't think industry affiliation is something you should worry too much about. The other characteristics we talk about outweigh that. So those are a couple that come to mind, but we've hit the most important ones in my opinion.
One specific type of company you emphasize in the book is holding companies, and I think you own a few of those. Mm-hmm. Why do you think those are, especially a fertile hunting ground?
Well, I think one really good reason is because, we talked earlier about the importance of capital allocation. So for a holding company, it's a good holding company. It's all about capital allocation. And that's the kind of the theory of why it exists, is it to be able to take cash flows from a variety of businesses that it's holding and redeploy them in a high return area. Keep that focus. So a really good holding company has the ability to do that. And so that's why they've always appealed to me. And there are a number of good holding companies. Obviously, Berkshire is one kind of holding company, but it's not the only kind of holding company. There's also the Lifcos of the world, like you have in Sweden. It's also a holding company. And that structure can work really well if you have a culture at the top that focuses on return on capital and those sorts of considerations. So yeah, I like that structure.
That's taken you all the way to Sweden.
Yeah, take me all around the world.
Yeah, but Sweden is a bit interesting in that aspect because we have a lot of holding companies.
Yes.
There is both the typical like investment trust, we call them investment bolag, but there are also those that we that are more like serial acquirers that we call them. Is there any of those groups that you are more interested in, and why?
Yeah, I like a number of them. So yeah, I did some work on ad tech and Lagerkrans, and the one I own is Lifco.
That's interesting. Yeah, Carl Bennett is the founder there, and you mentioned Lagerkrans and AdTech, and those were both spin-offs from Bergman and Beving.
Yeah,
and to a short history of that is what you can see there is that they have had a strategy that when they have acquired like a set of companies, I don't know if there is a specific level, but like more than 100, 150 companies, then they spin off into a new one. And you could also see that the managers in those companies move between the companies a lot. So you have like a VP moving over to the CEO spot in one of the other companies.
Yes. So I love those companies because, again, they also have this focus. I mean, they this focus on return on capital. So it's in all their letters. They talk about it. They publish it. They build incentives around that. And so I love that. And they've worked so well for so long. They're just compound. So yeah, well, I had to choose one. I chose Lifco. And I've spoken with people who've worked there, run divisions for them. I talked to the CEO. I think Per is a very thoughtful guy and definitely gets it. And I came away from that conversation feeling very confident that he knows what it's all about. And the other nice thing is he's relatively young. He's still in his 40s. That's another thing. A lot of times we get these capital allocators after they've already had 30-year runs and everybody celebrates them. So it's nice to be able to find one that is still should have many, many years of compounding ahead. So yeah, I like the structures that they do smart things. They don't use a lot of leverage, financial leverage. They have a very well-defined set of opportunities, and they kind of stick with that. Because in the U.S., there's also, if you say the word roll-up to people, they probably shy away because there's been lots of examples of roll-ups that haven't worked over here. And one of the differences is the roll-ups use a lot of debt, typically. And they're just looking to just gobble up and they combine lots of sales and then they cut expenses. It's not the same. Or a lot of the Swedish ones are more about keeping decentralized structure and building businesses. And so that works very well. And we have some of those over here, like a Danaher would be another example of a company that's very successful along those lines. In Canada, of course, you have Constellation Software would be a company that's kept that decentralized structure and has been able to acquire hundreds of businesses over time very successfully. So that's probably a hurdle a lot of investors still have to get over is they shy away from companies that are acquisitive. But there are very different kinds of acquirers. There are acquirers that do big splashy deals that use a lot of leverage and can get into trouble versus a patient, thoughtful owner of businesses like a Lifco.
Do you think it's more about like, I was going to say, to compare like defensive acquisitions and offensive acquisitions, but then I thought about Facebook and then it just, fell down.
Yeah, that's right. Yeah, I think it's also important to have it to be kind of steady acquisitions. So it almost becomes part of the core competency of what they do. And it's just something they do. They acquire, and it's consistent. They have a pipeline. They're going through names, and I don't like it so much when it's really patchy. They try to do bigger deals, and Also, it's important for the compounding. I mean, we talked before about reinvestment. So if you have a holding company that will decide to sit out a year, that affects that compounding.
I think one hurdle that I hear investors mention is that, I mean, many of those Swedish acquirers that you mentioned, they can buy companies for like 6 times earnings or something like that. And they have done that for such a long time. But when will it end?
Yeah, that's the question. Every investor who looks in this space is going to spend some time figuring that out. I am comfortable that, say, like a Lifco has plenty of room. Number one is some of them are still pretty small, so that they got a lot of room. But also the ones that can go and have proven that they can do this across borders is really important. So the ones that can acquire all through Western Europe and and even have North American holdings, those are ones that are, I think, have a lot more runway. And then the opportunities are always evolving. So we have a certain opportunity set of companies today, but you don't know what it'll look like 10 years from now. There might be companies today that are very small, but then 5-10 years, they're going to be right in that sweet spot for acquisitions. So the population, that mix is always shifting around as well. But there are still thousands and thousands and thousands of little companies doing things that are ripe to be purchased at some point. And there's a natural life cycle. Sometimes, the owners, they get to a certain point in their life and they're done with it. There's lots of reasons. But so far, I think of those kinds of companies have lots of room. The other thing is kind of to explore is the total addressable market. What's in their space, and it's better to have a holding company that can add new verticals, that can explore and get into new spaces. So maybe if they run out of room here, they can still explore other areas. So you look at a Berkshire and what they've invested in over their long life. You look at Lifco, the different breadth of companies they've acquired so far, versus a company that's stuck in a very small niche where they may more quickly hit that ceiling.
Optionality.
Yeah.
But I think also from if we just stay at the Swedish side, I think it goes both ways a bit. I mean, there are a few examples in Sweden which has been quite niched, and they have managed to grow a lot. Anyway, we have Nibe, for example, with I would say fanatic CEO in Gert-Erik Lindqvist, and Nibe is more than a 200 bagger the last 25 years. Assa Abloy is another example in the lock industry. But then, as you mentioned, there are a lot of acquirers that are, quite broad in what they buy. They just want to buy quality companies, often like that they are in specific niches where they are in. We interviewed the team who wrote the Moat Matters book, the Morningstar. Book.
Pat Dorsey.
Yeah, exactly. Not Pat. We didn't interview Pat Dorsey, but
Heather Brilliant, episode 5.
Oh, okay.
And they have a concept called efficient scale, where you have a market leader in a really niche industry, which can defend that for the long term. And I think many of these serial acquirers focus on that.
Yeah, it's always neat when you find a business that's able to take something that seems otherwise pretty humble, like HVAC or pest control, like a Rollins, and and they make it into a fantastic business over a long period of time.
Let's shift focus a bit from the business and to the investor. Hunting for 100 baggers is a big challenge that I think requires a lot of curiosity. So where do you start?
Yeah, I think you have to like the hunt. You have to enjoy learning about businesses. You have to enjoy reading. And where to start? I'd say start with what interests you. It's tough to research a company that you don't like or you're bored with. So,
do you have a specific process? For how to go about it?
Because I've been in the business a long time. I have a kind of an inventory of names I like, and I have a watch list of companies, but. So I don't. If you were starting from scratch, I don't know what I would do. There's screens and other things. But for me, no. There's not really a systematic way that I go about looking for them. I read a lot. Like I say, I have kind of I talk to a lot of other investors, everything from Twitter to, I'm not particularly picky about where the source of an idea comes from. I just keep the antennas out and listen carefully.
I guess you have worked up your pattern recognition well.
Yeah, I guess that's it.
And in the book, you bring up Sosnoff's law. So can you explain a bit what that is?
Sosnoff's law is kind of tongue-in-cheek, but I think there's some definite truth to it. And it says that the returns on investment vary inversely with the thickness of the research file. So in other words, the more time you spend on a name, probably your return on that name's not going to be as good. I guess it's a way too of saying that the best ideas really kind of pop out at you. And it's like, wow, this is exceptional. And if you have to, really do a tremendous amount of work to understand something, and you just find yourself spending a lot of time on a name, then perhaps that your return will be lower. That's Sosnoff's law. And that's something that he found in his experience. He was a money manager for more than 50 years.
And we touched upon valuation already, and it's of course a vital part of the equation for any investor. So what do you think is the most common problem with how investors in general behave and value stocks today?
I think the most common problem is people use a multiple without considering the quality of the investment. It sounds simple, but you see this all the time. People will say X stock's trading for 5% free cash flow yield, better than this one, which is 4, or this one has a P of 29, this one has a P of 20, and say one is cheaper than the other, but then they ignore the whole return on capital, reinvestment, the whole engine that makes the investment go. So if I were to tell people something along those lines, I'd say, you have to imagine valuation is on a scale, and the market generally sorts them out right over the long term. The companies that have higher returns on capital generally have higher multiples than those that don't, to be very simple about it. And to find a deal is to find something that's off that line. So maybe a company that does high return on capital is trading at an unusually low multiple, might be an opportunity. So you have to take into account that piece.
If we go into portfolio construction, you have mentioned that you like to have like 10 to 12 stocks in your portfolio. And having read the Bessenbinder study, that study concludes with that only like 4% of companies beat T-bills. So how do you reconcile these two, or should you reconcile these two?
Yeah, I love the Bessenbinder study. Well, I mean, I think there's no right answer necessarily to how many names you should have. I think it's a lot personal preference and what you have the bandwidth for and how much you like to get to know your names. Obviously, if you have 40 names, it's a lot more difficult to really know those businesses if you just have 10. So, but it doesn't necessarily mean that your returns are going to be better. There's a lot of research that shows concentration delivers better returns than not. But I think what you do, how you reconcile them is, it kind of goes back a little bit to what we were talking about with the 100-bagger study. I mean, we know what drives outperformance over a long period of time. We have the formula. It's not the only formula, but we have a formula, which is high return on capital, reinvested, keep doing it for years and years. And so that screens out a lot of stuff. I mean, I'm sure if you were to go back in the Bessenbinder study, you'd find, there's not going to be top performing names among utilities. And I don't know, there's going to be some businesses there that we can, if we're building a very focused portfolio, we can weed out some of these subpar businesses and weak assets and not own them. And I'm sure you improve your odds a great deal by screening out that stuff. It's almost like if you were looking at I don't know if this is a good analogy or not, I just thought of it, but if we were looking at, say, the National Football League, and if we were to say what teams are going to be in the top half and which teams are going to be in the bottom half, we'd probably have a pretty good idea. Yes, there would always be exceptions, the bad team that had a good year and the good team that had a bad year. But by and large, as a population, from year to year, you kind of know which teams are going to be good and which ones aren't. And I think in the stock market, it's similar. We can we know who the players are, and we know who they aren't.
The only issue with that is that the odds typically reflect that, right? So
That's right.
we had Michael Mobosan on the podcast recently, and he mentioned that. So maybe you want to explore that a bit.
Yeah, the odds. The odds are a big part of it, as you know. So yeah, you can, even if you know the winner, if everybody already knows it, you're not going to get much return out of that. That's the art of investing, is somehow marrying those two.
Yeah, and related to that is the Kelly criterion on concentration. So can you tell our listeners a bit about that?
Yeah, in the book I wrote about the Kelly criterion, I don't really pay much attention to it. I think if I rewrote the book, I might leave that out. But the basic idea was, it's a mathematical way to sort of show that how much you should invest as a percent of your portfolio. It originally came out of kind of gambling. How much should you bet if you know the probabilities? And how would you maximize your returns over time? How should you weight it given certain probabilities? But for investing, of course, we don't know the probabilities. And the Kelly formula has you overweight quite a bit. So even if you were to use that as a framework, and I think I say this in the book, you wouldn't probably use the full Kelly. You'd probably do a half Kelly. What people do, they cut it back a little bit. But the exercise, it's interesting to go through if you've never seen it, just because it shows you, people are sometimes surprised at the percentage that you should be putting in, what percent of your portfolio you should put in if you had this certain probability of success and this kind of payoff. And it sort of bolsters the whole idea of concentration.
Yeah, we talked with Daniel Chang on the podcast recently, and he mentioned that he had a 100-bagger, and he saw that this is probably going to be a 100-bagger from his analysis. And then he bet 0.5% of his portfolio on that. And that's so stupid, because then you don't get any performance out of it.
Right.
But do you have any percentage thresholds for the size of each holding, or any such rules in your portfolio?
Yeah, I have my own rule, which is I stop at 10%. And there's no magic to that number. Everyone has to kind of figure out what they're willing to do. But for me, 10% of the portfolio is as much as I would put in. But it can get bigger than that afterwards. That's okay. But I'm not going to go more than 10% of cost. And as a practical matter, I usually kind of stop somewhere around 8 and whatever, somewhere around there. And but I do that for a couple reasons. One is, you're going to make mistakes, so you don't want to be carried out because you put 25% of your portfolio in one name that you got wrong. And also, I just think in my mind that I can find 10 names at least. So there's no reason to, put so much in one. And also, there's a certain element that you just don't know. Like if you were to take your portfolio now, rank them 1 to 10. I'm pretty sure your number one ranked name is going to be your best performer. It's just not the way it works. You're always surprised. There's always things that come on. It might be your 8th name. So if you have, if you're overweight and then underweight, you're hurting yourself. I kind of try to start somewhere balanced, and of course over time it's going to get unbalanced. But that's my personal way to do it.
Yeah, it's quite often that people put most money in the stock that they think have the highest upside.
Yeah.
But maybe the highest risk as well. So
that's pretty common, I think.
So say that you have nurtured a list of 50 companies well that are all of high quality, and you own 10 of those. Can you explain your thought process for when you may decide to sell one of them to buy another?
Yeah, that's always tough. I like to say selling is one of the toughest things to get to do well. I don't really think anybody's a good seller, because you're always going to, if you're doing this right and you're investing in good companies all the time, you're going to sell and it's going to go higher at some, it's going to be higher down the road. So it's how do we make the best decisions? And in the case you're talking about where you might make some switches is, every once in a while, the market gives you an opportunity to buy something at an insanely good price, and you have to shift to take advantage of it. We'll have another March of 2020 kind of event, and we'll have a bear market of some kind in the future where you have massive drawdowns of names and something's going to be crazy. So that would be one, but just that would be one reason to switch. But otherwise, I think you have to be reluctant. I mean, every once in a while you have a chance to upgrade your portfolio, and I don't mind doing that at the margin. So let's say, one company I have has gone up a great deal. Another one has come back. And I know this business is kind of better than the one I own. And I've always liked it more, but I've never owned it. There might be reasons that you might then make a switch. But I think in general, you want to be reluctant to make those kinds of changes because the name that you put in has to be quite a bit better than the name you let go because of taxes and switching costs. And you just have to be humble about your ability to time these things. Most odds are you're probably better off sitting with what you have. But that's a good question. It's a really tough question. And maybe I'll write about this in the future blog post, but there's no easy answer to it.
We look forward to that. And maybe the ultimate way of being a reluctant seller is the coffee can approach that you highlight.
Yeah. I think this would be great for individual investors to do, is the coffee can approach, which is, it came from an old article that Robert Kirby wrote in the 1980s in the Journal of Portfolio Management. He was a money manager for Capital Group. And he said he got the idea from the Old West in the U.S. where pioneers would take their valuables and stuff them in a coffee can and then kind of bury it somewhere. And he thought he got that idea because he had a client whose money he managed. And then unbeknownst to him, this client of his was a woman. Her husband was also trading on his advice. But there was one difference, is that he never sold anything. And so years and years go by and the husband dies, and then the wife brings his account in and has Kirby managed as well. And he looks at his account and he's surprised to see that he's been doing this all these years, buying his picks, but he never sells them. And what he discovers is that account is done way better than the one he's managing. And that the result is there are some names that, there's one name that's worth more than the entire account that she has. And this becomes very lumpy. And so he starts to use that as an opportunity to reflect on money management and how we would be better off if we weren't so active, And that I'd recommend you can find that piece if you just Google it, the Coffee Can Portfolio by Robert Kirby. But that's the idea of it. So the idea, I write about in the book is as an individual investor, you take 10 stocks that you think would be great to own for the next 10 years, and you create that. Maybe you set up a separate account, you buy those 10 names, and then you forget about it. And then, 10 years later, you look at it and see what you have. And invariably, you're going to have, maybe one goes to zero. Maybe a couple of them go out of business. But, you'll also have one that goes up 10x. So, and the reason why you don't look is because it kind of protects you against yourself. If people see it, they're tempted always to take profits when something moves up quickly, or they get scared out of things when they draw down. They get cut in half and they want to get out of it. And this forces you just to leave it alone and see what happens. So I've seen a number of people try this experiment at different times. And it's always that same kind of pattern to the portfolio. I know Boyer Value Management had a coffee can they recently opened after being put away for 10 years. And the same thing, they had one stock that was up a whole lot, and they had a couple that did very poorly. But overall, it was a solid market-beating return. So it's just it's an interesting way to defend yourself against your overactivity.
And have you used it yourself?
I haven't. I have not. And maybe in a partial way, because I have some money that I set aside that, like I have Berkshire Hathaway. I don't look at that, and it just sits there. I haven't touched it. But otherwise, I don't really have a personal account anymore, because when I started my fund, I liquidated everything and put it in the fund. So I haven't had a chance to really do it.
And the fund is actively managed?
Fund is actively managed, and not quite coffee can. I mean, ideally, if I'm doing it well, most of the names I have now I'll still have 10 years from now.
And are you then trimming your holdings back and forth?
Yeah, I'm not generally a fan of trimming. I usually just let them go.
And what do you think about the 10 years? Like that's something that just...
Yeah, it's kind of arbitrary, but it seems like a long enough time to have a really outsized result like that. And it's not too long that, if it was 25 years, that's a really long time. It's 10 years seems like something people can reasonably do.
Yeah, and also the lifespan of companies is now decreasing, I guess.
That's true too.
So something related to this is also cash. And if you have a coffee can investing approach, then you just put all your money and let it compound, I guess. But if you're more active, then you might want to hold cash for the great opportunities. And you mentioned that in the book.
Sure.
As well. So what is your view on that?
Well, in general, I don't really actively manage to a certain cash percentage. I don't say, well, I want to always, keep 5% cash around. I just kind of let the cash, as people say, it's residual. Just kind of you work to what you want to own and you focus on the weights that you want to own them. And then cash is just kind of the rounding error there at the end. It feels nice to have cash, to sit on 10% cash, but it is a real drag over time. And unless most people aren't going to be able to deploy it and trim it back at the right times. You have to think about what's reasonable for you to do. Are you going to be able to call all the twists and turns in the market and put your cash to work at the right times and then take it out at the right time? And I think that's a very hard thing to do repeatedly. So in general, I'm looking to just invest it when I have the opportunities. And when I don't have the opportunities, I'm okay letting the cash sit for a little while while I think it over.
And how is your cash position now then?
My cash position now is about 10%, maybe a little less. And part of that is because I've had recent inflow. And I did sell one name recently, so I haven't put it back to work just yet.
What cost you to sell that position?
Well, there was a large transaction that changed the company. So it's a totally different business, totally different company now. And it's already changed in a big way. And it may not be so bad, but it's not what I originally signed up for. So
you can always buy it back.
Yeah, I could always buy it back.
Yeah, really interesting to hear about your thought process there. And besides finding great companies and having a strategy, investors also need to deal with their own mind. Everyone may have the opportunity to be a great investor, but very few succeed. And what personal traits do you think one need to hone in order to realize 100 baggers result?
Well, you got to be curious, which gets you learning about lots of companies. Definitely have to be patient because, even the ones that got there fast still took a decade to do it, like in Monster Beverage, which we mentioned earlier.
And what is the shortest route to 100 bagger?
I think the shortest was Franklin Resources, which did it in about 4 years, but that was coming off of a horrific bottom. I forget which bear market bottom it was. If it was 08 or 73, 74, I don't remember now. But you can get extreme results like that, right? Off of vicious bear market. You happen to bottom tick something and
but you still need to hold it for 4 years. And
that was again in my study, which we talked about earlier. I took away those the junior miners and the little biotech. So perhaps I'm sure there's if I did a book day, maybe I have a chapter on crypto. There's stocks their crypto has gone up 100-fold in less than 4 years. But for the stocks that I covered in the study, that's what it took. So patience, that's a big one. And you got to have some willingness to be, you got to have something of a thick skin because you're going to hear constant chatter to do something. The financial press, everything screams at you to make trades, to buy this and you want to be part of this. And if you're going to get 100 bagger, you're going to have to hold that company through a period of time where it's not the hot thing. One of the things from doing a 100 bagger study is I like to say Berkshire Hathaway, which was the top performing name in the study, still got cut in half a handful of times in its life. And there were also stretches where it went nowhere for a long period of time. There's one 7-year stretch where it went nowhere. So you can think about the enormous pressure, 1 year, 2 year, 3 years, and especially if you have investors. And it's like the stock has gone nowhere. Meanwhile, you're seeing other stocks go up and you're seeing other things work. I mean, it takes a lot to be able to tune that out and stick to your thesis.
You need to have a good set of investors in the fund then, right?
Yeah. I mean, that when I started my fund, I talked to several people that I knew have been running funds for a long time. And it was funny because I got independently the same kind of advice. And it was not to accept just anybody's money. It was to make sure that your partners buy into what you're doing and your process. And they said, even if you just let in one bad partner, they can make the experience miserable. And so I had an early test of that because we had 2020 and the fund took a big drawdown in March like the rest of the market. And I didn't have anybody pull out. In fact, I had people put more money in. So I'm lucky. I have a great group of people that I have in the fund.
And what is your advice to help us improve our patience?
Well, it's where you put your focus. Focus on the company itself, not so much on the stock price. That's number one. And also be careful what you allow into your consciousness in a way. Don't, be mindful of what you read. Don't read the financial press. Well, what this is something that everybody says, what do you read? Everybody automatically will say the Wall Street Journal, Financial Times, The Economist. Why? They're telling you what's going on now. It seems everything seems so important now. And I think I'm not saying you don't want to read any financial news at all, but you have to maybe compartmentalize or have a small amount of time that you dedicate to that kind of stuff. And just to be careful what you feed in your mind. Spend more time reading books and thinking about longer term trends and ideas.
And only the best podcasts.
Only the best podcasts. That's right. The most thoughtful.
And yeah, this reminds me about our conversation with Jake Taylor. He talked about this information onion, where he, at the core of the onion, had like the company 10Ks and stuff, and then layer after layer, and then he ended up like social media at the end, I think. Mm-hmm. But he still had a little bit of trouble to not stay on Twitter and look for things, because every now and then he found that little great piece of idea or anything. And you are also on Twitter.
Yeah, I also have that same kind of love-hate relationship with Twitter. Because there are times when you find something on there and it's really good. But there's a lot of junk, people posting, what they're drinking at the moment. And, people who want to make comments all the time on politics. It's hard to find people who will stick to only putting out good things or something really interesting that they find. And yeah, it can be a real sinkhole because you can be on there and it's like junk food. And suddenly you realize you spent 40 minutes on Twitter, like what happened? What did I just waste my time on? So yeah, that's a love-hate relationship. It takes some management to, limit the amount of time you're on it and be very specific about why you're on it, what you're looking for.
Do you have specific times of the day where you check it, or?
Yeah, I try to do it kind of just in the morning. I will go on. But otherwise, I'll tweet something whenever I happen to find something that I think is really interesting. It could be anytime. I don't tweet as much as I used to. I used to do it multiple times a day. Now I'm okay if I go a few days without doing anything. It's okay. I don't worry about it.
But is it similar there that you have honed like a fan base, so to speak, where you have you get thoughtful responses and so on?
That's right. Yep, and you can use the mute button. I'm a liberal user of the mute button, so you can strain out certain things, and and also resist the urge to get involved in these back and forths and debates and things. Somebody says something I don't agree with. I don't feel like I have to go out there and correct them. People are free to say what they want, and that helps limit the amount of time you spend. I mean, what good is it to go around arguing with people about whatever?
You stay away from the meme stocks and Tesla and so on, right?
Yeah.
So in the book, you write that you have no attachment to ideas and no problem changing your mind, for example. So it's clear that you are aware of confirmation bias, for example. But which would you say are your most common biases?
Well, there are good biases and bad biases. I have a bias towards finding companies that are making a profit and generate cash flow and returns and all the things I can look at, which, you're smiling and I know, but it also means that, I'm going to miss some things. I'm going to miss some really good businesses that aren't showing profits, but that will someday in the future. And you have to be okay with that. So, I don't know. I'm trying to think of an example, but I don't know, something like Wix.com, which actually I use for my website. It's a great service. Maybe it is a great stock, but it doesn't have the kind of characteristics necessarily that I'm looking for. So I'll probably miss it. Or maybe I'll own it 5 years from now when it finally, I don't know. But you have to be okay when you create filters. You have to be okay missing things. I mean, there are other biases that can help and hurt. I have this bias for insider ownership and skin in the game. But obviously, there are great companies where their skin in the game has been pretty light, or insider ownership is small, and companies have done very well. And I'm gonna miss those. I have other biases. I mean, probably a common bias among investors of my type would be a bias against the extractive industries. You're not going to get involved with miners or oil and gas or uranium. And so that means you're going to miss those. There's going to be times when this looks like it's going to be a fantastic uranium bull market, and you're going to miss it because you're not involved in those kinds of business. So that's another bias.
Yeah, I was listening to Vishal Kandelwal's podcast, 1% Show. I don't know if you heard it.
Mm-mm.
No, it's fairly new, but I think it's very good. Barry Ritholtz was there, and he said that there's more to learn from failure than from success. So since you write in the book about both hindsight bias and survivorship among the winners of the 100 baggers are the winners, of course. So I'm curious to hear your thoughts on failure versus success stories.
Yeah. You can learn from failures as well, of course, and you wouldn't necessarily exclusively do one or the other. I think people sometimes can overdo the learning from failures because it sounds smart. Oh, let's learn from failures. But I think you also learn from successes of people who have done it very well over a long period of time. Give you a model of how to do it. So I think it's like having 2 feet, left feet, right foot. You need to look at both. With 100 baggers, I thought a lot about that, the survivorship bias. And it's more of like a point of logic with 100 baggers. Like, what does it take to be 100x? Well, you got to multiply your stock on at least 100 times. Okay. That has to happen. There's lots of ways to get there, but that's the first little piece of truth. And then you kind of back into it. Okay, well, how do you do that? Well, one way is you have high returns on capital and reinvest for a long period of years. That gets you there. So then, you can kind of keep reverse engineering further low, down as we've done. So what are the components of that? And we've talked about a number of them: growth, sales growth, the insiders, whatever, all the different things we've talked about. So it's kind of a logical progression. The failure is almost implied. So it's like, well, what companies didn't do that? The companies that don't have high returns on capital aren't able to reinvest. And so you get the failures in there. Now, there may be companies that, for 20 years cruised along and then tanked. And that can certainly happen. We've lots of examples of businesses go obsolete. And it's very useful to understand those. I think understanding failure that comes after success is really an interesting place to study, rather than just say failure generally. So let's talk about a company that was very successful and then lost it. What happened to Kodak and Xerox? What happened in Nokia? Why did they make that mistake? Those are the kinds of failures that would interest me the most. I have a portfolio of companies that have all been successful. Now I'm particularly interested in, what's going to mess it up, and how will I be able to tell when they make that, a critical error, or when they slip from the successes to becoming one of those case studies people will look back in the future.
Were there many of the 365 stocks in your study of 100 baggers that actually went out of business after?
Not that many. There are some that just don't exist because they were acquired. But other than, there were some very high profile ones. I mentioned Xerox, Kodak, newspaper stocks will come to mind. Valiant was a 100-bagger. Valiant got there very quickly. I think it's in the top 10 in terms of length of time. I think it became a 100-bagger in under 5 years, if memory serves, something like that. But of course, it became a high-profile failure. So there weren't that many, but there were some.
So Chris, after having discussed a lot of topics and after also reading your book, what else do you recommend us to read to improve our odds of being able to find and hold on to these 100 baggers?
Well, I always like stuff that's not related to finance at all. I like books that kind of deal with critical thinking skills. So, I wrote my last book was called How Do You Know? And it was about general semantics, which is kind of its own little discipline. And it's about the way we use our language and symbols and how that influences our thinking and whether it matches up with what we're actually trying to describe. So I think something like that can be helpful because it helps you separate kind of the nonsense in people when they talk about things that are very abstract. You don't have to take it as seriously. I don't know if I'm making any sense. It's kind of a hard thing to describe or talk about, but there are lots of little tricks and tools. You talk about Munger's mental models. I think general semantics is one of those good little mental models. And so I wrote about that in my last book, How Do You Know? And I think that kind of stuff helps you tune out the noise. And of course, you have all these books behind me. I read a lot of philosophy, which I think is, I enjoy just thinking about some of these bigger picture issues, and that can help give you some perspective on your investing.
It seems like on the philosophy side, I'm a bit impressed that you read that, because typically, isn't that normal that the younger people read philosophy and then life happens more or less?
Yeah.
Chris is still young.
Yeah, I don't know. I guess it depends on which philosophers you're reading, but to me, it's almost like it's a lifetime thing. It's almost, you never really get to the bottom of it. It's always different ways to think about things, different models. There's always different questions. So, it never really gets old.
And are you writing something, a new book now, for example?
Yes. I have a book that it's being serialized in a publication called Etc., which is published by the Institute of General Semantics. And it's another attempt to try to explain some of these tools of general semantics more simply. It doesn't really have to do with investing specifically, although it was inspired by stuff that I've done. That's just something I kind of do a little bit on the side. I've read a lot of Alfred Korzybski's stuff, and he's the guy who created the discipline of general semantics. And so that's one thing that I've done. But I would like, at some point, I'd like to do a kind of write about my experience with Woodlock House. But I don't want to do that until I'm much further along. That's something maybe 10 years looking back. There's always a possibility of doing some kind of update on 100 baggers. That would be a lot of work, but I think I would definitely do it differently. There's some things I've learned since. We've talked about some of them that I'd emphasize more, de-emphasize certain other things. And now that I know more, like back then I didn't know about these companies in Sweden that we talked about. It'd be nice to try to push to have some more international coverage on some of these names. In my book, I explicitly said I'm only going to focus on U.S. markets, but I found some interesting things that probably deserve a chapter. These serial compounders in Sweden, and there's some other interesting ones in the UK. So I don't know. I don't know what I'm going to do next, book-wise.
Lots of interesting material coming up. I can hear that. Thank you so much for taking the time to come on the podcast, Chris Mayer. For people who want to buy your book or follow you, where can they find you?
Yeah, all my books are available on Amazon, and I'm on Twitter, so it's Chris W-M-A-Y-E-R. You can find me there. And I write an occasional blog at Woodlock House Family Capital. If you Google that, it'll come right up. So that's how you can follow me. And yeah, thank you much for having you guys. It was a very good conversation, thoughtful conversation. I appreciate the questions. And yeah, thank you for having me.
Thank you so much.
Thank you for listening to Investing by the Books, a podcast by Redeye. You can follow us on Twitter at IB_Redeye and email us at ib.podcast@redeye.se. To improve the podcast, we really appreciate your feedback, so please rate and review us. Notice that the content in this podcast is not and shall not be construed as investment advice. This information is meant to be informative and for general purposes only. For full disclaimer, visit redeye.se. For the sound engineering and editing of this podcast, we thank Gustav Tesch. I'm your host, Eddie Palmian, and until next time, I sincerely wish you the best of luck on your journey through life and investing.